Have you ever seen a 100-story skyscraper built on loose sand? From a distance, the glass shines and the architecture looks perfect, but up close, there is no steel skeleton anchored to the bedrock. The whole structure is sinking under its own weight. Wall Street is celebrating the most anticipated stock market debut in tech history, but underneath the hype, the numbers reveal a deep structural instability. This chart shows the staggering gap between reality and the dream. Down here is the $25 billion generated in revenue for 2026. Next to it is the valuation investors are targeting, a towering $1 trillion. Buyers are paying 40 times more than the actual revenue. To justify that giant bar, you have to assume this company captures the entire global market while cutting operating costs to almost nothing. That assumption works well for traditional tech companies. A normal software business writes the code for a program once and then copies it millions of times. Adding a new customer costs them virtually nothing. Generative AI operates like a heavy manufacturing plant. Every time you ask a chatbot to write an email or generate an image, it has to build a brand new response from scratch. It requires constant raw materials in electricity and processing power to build every single answer. Valuing a high-cost industrial operation as if it were a frictionless piece of software creates a hidden trap, and that trap is sitting right under the broader financial system. To understand why, look at the physical reality of the cloud. When a model cranks out an answer, heavy machinery inside these racks has to spin up and consume huge quantities of electricity. Because these specialized computer chips do so much work, they burn out quickly. Within 2 or 3 years, they become obsolete and must be replaced. As the company adds more users, their costs don't flatten out, they multiply. Take a look at these internal projections. This upward line represents user growth. But watch the second line, financial profit. It plummets into the red, creating a widening chasm. In 2026 alone, estimates show a loss of up to $25 billion just to keep the current servers running. When we project this timeline out to 2030, the red area swallows everything. The total expected loss sits at roughly $665 billion. When the company asks the public for $60 billion, that money isn't for building new offices or inventing the next big thing. It is life support, meant to keep the existing machinery powered for the next 2 years. If getting bigger means losing money even faster, you can never outgrow your expenses. The business model is structurally broken. The stock market operates like a closed plumbing system. There is only a set amount of money flowing through the pipes. If a huge central pipe opens up demanding cash, that water has to be drained from somewhere else. The major funds that can actually write these billion-dollar checks don't keep cash sitting around. To participate in a giant public offering, they have to free up funds by selling off their most reliable, easiest-to-trade assets, their safest tech stocks. Once that heavy selling begins, the prices of those reliable stocks start to dip. Trading algorithms detect the drop and automatically bet against the market. This pushes prices down faster, activating automatic sell orders from regular investors, creating a cycle of panic. Most people's savings are concentrated in a handful of familiar giants, like Apple, Microsoft, and Amazon. These few tech leaders represent about 1 out of every $3 in a typical retirement account. That means billions of dollars draining away to fund an unprofitable business can actively shrink your pension or 401k, even if you never chose to invest a single dime in artificial intelligence. You might hear that cash-rich tech giants will step in as a safety net if things get rough, but the companies positioned as rescuers are actually chained to the very business they would theoretically save. This flowchart maps out the circular loop. Microsoft gives OpenAI vouchers for computer processing time. OpenAI uses those vouchers to rent Microsoft servers, and Microsoft then counts that spending as new revenue. This isn't a small side project. 45% of Microsoft's future commitments are tied directly to these orders. If OpenAI stops renting those servers, that loop snaps. That chunk of future earnings, nearly half of their projected growth, simply vanishes. Up until now, these catastrophic losses have been shielded by private funding. But the moment a company files to go public, that secrecy evaporates, and strict federal regulations step in. Regulators require public companies to use real accounting. Every piece of hardware must be listed as an industrial asset that loses value every day, not a vague research expense. For the first time, the negative profit margins of AI will be visible to the world. Once the audited financial reports prove the underlying math doesn't work, there is no more room for hype. It forces a reality check that will ripple across